Welcome to my channel, Fiscal Voyage. I'm Felix, and in this channel we like to do 5-minute stock analysis of different companies that you guys write in the comments. So make sure to leave a comment with a particular company you would like me to analyze for my next videos. So with this video, we're gonna do a 5-minute stock analysis on Simon Property Group, which suggested by Alfredo. Thank you, Alfredo, for suggesting this company. I actually own shares of this company, and we're gonna determine if the current price is a buy, hold, or sell right now. All right, so here's the 5-minute stock analysis on Simon Property Group. You can find it in the New York Stock Exchange as SPG. Basically, the company is a commercial real estate company, the largest retail real estate investment trust, and the largest shopping mall operator in the U.S. The company operates 5 retail real estate platforms: regional malls, premium outlet centers, the mills, community lifestyle centers, and international properties. It owns or has an interest in more than 325 different properties. Just a side note, I live in South Florida, and the Mills is here in South Florida, as well as some other premium outlet centers. And these locations are always packed and hard to find parking spaces. So a lot of people love to go to these shopping centers. All right, so let's look at the fundamentals. Revenue grew at a 4.6% rate from 2009 to 2018. Net income grew at an outstanding rate of 25.8% that same time period. They currently have an A credit rating, which is outstanding. Operating income grew at 6.85%, and free cash flow, since it's a real estate investment trust, we look at free cash flow instead of earnings per share. It came in at 9.81 annual growth rate in that 2009 to 2018 time period. And the last 5-year free cash flow growth has been 9.49%, and revenue has been increasing, but a very lower rate at 1.82%. Let's continue with the fundamentals. Last year, free cash flow came in at $11.05, net margin at 43.07%, which is higher than the 2017 margin of 35.11%. Return on equity, which is outstanding, 70.66%. Debt to cap is pretty high at 86, but is a real estate investment, so they tend to be higher in the debt to cap ratio. The current yield is a nice 5.74%, which is above the 5-year average, which is 3.92%. So almost 200 basis point higher with the current yield. And they have a very safe dividend payout ratio of 68.51%. Normally, REITs tend to hover around the 80 to 90% in the payout ratio. So with this payout ratio, it looks like they could continue growing their dividends. And actually, they've been growing dividends for 9 consecutive years with a 5-year dividend growth rate of 12.56%. So we add the 5-year growth rate with the current yield, we get a Charter rule of 18.3. For REITs, you like to see it over 14, so the 18 meets that criteria. And their most recent dividend increase was this year at 5.06%, so it's a couple of percentage points higher than inflation. For future outlook, for this year, fiscal year 2019, analysts expect a $10.88 free cash flow earnings versus the $11.05 from last year, so it is a little lower. However, 2020, they're expected to pick it up to $11.37, with CFRA projecting free cash flow growth of 5%. If we look at a dividend drill return model, projected total return is expected to be at 11.7%, which is great. I like to see companies over 9% here. In this model, we get it almost 12%. Currently, the current PE or P to free cash flow is 13.28. Forward price to free cash flow is 13.22. So it's how I like to see it. The current to be lower than higher than the forward PE. All right, we look at the fast graph. Again, the black line is the monthly closing price. The orange is the free cash flow with a average of 15 multiple, and the blue line is the normal PE. As you can see here, the company likes to track the blue line, which is the normal PE, which is a PE of around 19 or 20. And right now, as I mentioned, you get the company at a PE of 13, and it's basically lower than the normal PE of 15 for the earnings. So that's what I like to see here. And as you can see, analysts expect future earnings to be a little higher there. All right, so calculate the fair value. CFRA has a projected 12-month target of 158, Morningstar at 189, Fast Graph at $215, Yahoo at 175, and my dividend discount model analysis at 147. Averaging out to 5, we get a fair price of 177. And currently, the company goes for $144.38. Means that the company is undervalued by 22.7%. So with that, I recommend this company as a buy. I actually bought this company maybe 3 weeks ago, I think. I own a nice amount of shares, about $4,000 worth of shares. So I'm very happy with that. If it continues to go lower, I'm gonna continue buying more. I love the yield, the 9 years of consecutive increases, the very low payout ratio. So the stock's been hammered because of the fear of mall closures. So that's one of the drawbacks there. It was bringing the stock prices down. But overall, I think the company is going to go through this and continue performing very well. So with that, I have my recommendation as a buy. You could check out my portfolio of this company in the description. I have the link to my portfolio, so you can see it there. And so with that, if you have a company that you would like to see next, please leave a comment with the ticker and the company name. And if you find this video informative, please hit the like button and make sure to subscribe to the channel, because this helps a lot. And don't forget to check out my website, fiscalvoyage.com. Have a great one.